All right, let's unlock some serious financial knowledge today. We're cracking open Financial Intelligence by Berman, Knight, and Case. And let me tell you, this book is like that friend, you know, the one who spills all the secrets about how businesses really work.
It's so true. This book pulls back the curtain, right? Like all those financial statements we see, we glance at and kind of think, okay, that's the story. But it's rarely that straightforward.
Oh, not at all. It's like thinking you're snapping a crystal clear selfie,
Yeah.
but surprise, someone slapped a filter on it. And in the financial world, those filters, they can be potent.
Exactly. And the book calls this, get this, the art of finance, where those, what we think are, objective numbers, are actually shaped by judgments, estimates, assumptions, the whole shebang.
Okay, so let's break down this whole artful side of finance. One big one they dig into is revenue recognition. It's not as easy as money hits the account, record the sale, right?
You'd think, wouldn't you? But it gets messy. Take, say, long-term contracts. Let's say a software company. They land a huge deal, right? 3 years of software access, updates, the works. But should they record all 3 years of that revenue now, even if the client hasn't even logged in yet?
That just feels, I don't know, misleading. It's like counting your chickens way before they've hatched, let alone laid any eggs.
Exactly. That kind of what they call creative accounting, that can really distort the picture of a company's health. The book even mentions, get this, channel stuffing.
Yeah.
Like, picture a company, they're pushing mountains of products onto distributors right at the end of a quarter just to make those sales figures look amazing. So sneaky. How would you even spot that, looking at a statement? What are the red flags of channel stuffing?
Well, one telltale sign, if their accounts receivable, so the money owed to them, if that starts ballooning way faster than their sales growth, that might be a hint. It could mean they're booking revenue for stuff that hasn't actually been sold to the final customer.
Wow, that's some next level stuff. Makes you realize you can't just take those revenue numbers at face value.
Nope, not at all. And that's where this whole financial intelligence thing comes in. It's about knowing the nuances, right?
Yeah.
The potential for things to be, well, manipulated, and knowing the right questions to ask.
Right, right. So we've tackled the money inside, but the book also dives into, and this one's fascinating to me, depreciation. Like, that often gets overlooked, but it can really impact a company's profits. Oh, depreciation is like the perfect example of how these kind of boring accounting rules, they have huge impact. Essentially, it's how a company spreads out the cost of an asset, something big like equipment or a building, over its useful life.
Right, so instead of one giant expense hit, it's gradual over time. But how do they even determine that useful life?
$1 million question. And that's where it gets juicy. The book uses this great example from the waste management world. Waste management, the big guys, right? They realized they could make profits look way healthier just by assuming their garbage trucks could last longer.
So instead of depreciating those trucks over, I don't know, 8 years, they stretch it to 12?
Exactly. And because it's spread out longer, their annual depreciation expense is lower. Profits look better on paper.
I see where you're going with this. So much room for, like, interpretation. Even with something as, seemingly straightforward as a garbage truck's lifespan.
Oh, absolutely. And that's the thing. Depreciation, it's not just crunching numbers. It's about recognizing those assumptions, those judgment calls underneath it all.
It's not just reading the financial statements, it's reading between the lines.
Yeah.
Right. Understanding the choices behind those numbers.
Yes. And that, my friend, is the core of financial intelligence.
We're really getting into it now, peeling back those layers, seeing the art behind the financial statements. But before we get lost in a sea of garbage trucks, let's shift gears to another big one, the balance sheet.
Yes. The balance sheet, it's like a snapshot, right? Frozen in time, shows you what a company owns, what it owes, and what's left for the owners, all at that specific moment.
Right, like a financial selfie. But instead of posing, it's all about the assets and liabilities they're showing off.
And just like with selfies, there's always room for a little, shall we say, creative framing. Remember, historical cost, we touched on that. It means those assets. They're often listed at their original price, even if their value's gone way up or down since then.
Okay, yeah, that could be super misleading. Imagine a company owns some prime real estate, but they bought it ages ago. That land could be worth a fortune now. But their balance sheet, stuck in the past, makes them look way less valuable than they really are.
Exactly. And this is where things get even more interesting, especially with mergers and acquisitions. It all leads to this, well, often misunderstood concept.
Goodwill.
Goodwill. I've always wondered about that. It sounds so I don't know, nice, like a greeting card, not a financial statement. Haha, you're not alone. Goodwill, it basically means the extra a company pays when they acquire another. When they pay more than the fair market value of the net assets, that difference. Goodwill.
So like if they buy another company for, say, 100 million, but the actual assets and liabilities only add up to 70 million, that extra 30 million is goodwill.
You got it. And here's where that artful side pops up again. Figuring out the fair value of things like brand recognition, customer relationships, intellectual property that's tough, lots of judgment calls involved.
I can see how that's, well, right for some creative accounting. Companies could easily inflate that goodwill to make a deal look better than it is.
Oh, for sure, that's a concern. Investors, analysts, they watch that very closely. And remember, goodwill. Unlike those tangible assets that depreciate, it doesn't really go away.
Wait, so a company could make a risky bet, pay a huge premium for goodwill, and it just sits there on their books forever. No gradual expensing.
That's the current standard, yeah. The thinking is goodwill doesn't necessarily decline in value like a physical thing would, but it can be impaired if things go south, like a damaged reputation or if their market share tanks.
So again, it comes down to judgment calls.
Yeah.
How do you even measure a damaged reputation in dollars?
Exactly. And that's why, you can't just glance the balance sheet. You got to read between the lines. Look for those hints that maybe, just maybe, those assets are a little too inflated or if they're risks they're trying to hide.
Speaking of hidden risks, earlier we talked about how revenue can be, well, not always what it seems. The book also mentions companies using those, what are they called, restructuring charges to kind of, I don't know, mask their performance. What's the deal with those?
Restructuring charges, those are tricky. On one hand, they can be legit, like the real costs of shaking up a business, closing locations, letting people go, getting rid of outdated inventory. That stuff's expensive.
Right, totally get that. Cleaning up shop, so to speak. But then they can also use that to, like, play games with the earnings.
Oh, absolutely. It's a classic move. Take a big restructuring charge one quarter, profits look awful, everyone panics. But then those costs are spread out, boom, earnings get a little boost over the next few years.
It's like, look, we took our medicine, everything's fine now, but really it's just dot timing.
Exactly. And investors, they see right through that. It's like cleaning your whole house in one go, then claiming you'll never need to lift a finger again. Not realistic.
Not at all. So it's all about understanding, I guess, the why behind the numbers, not just what they say.
Couldn't have said it better myself. Financial intelligence, it's not just about the mechanics of accounting. It's seeing through those numbers, understanding the business decisions, the potential motives, everything behind the curtain.
Okay, love that. So we've done income statements, balance sheets, even waded into the murky waters of depreciation and goodwill. But you know what they say? Cash is king. Time to talk cash flow statements.
Ah, yes. The cash flow statement. If you want to know where the money is really going, this is it. It's all about the actual flow, in and out. No fancy accounting tricks, just the cold, hard cash.
So you're saying a company could look profitable on paper on that income statement, but their cash flow tells a totally different story.
Totally possible. They might be making sales, but can they pay their bills? Cash flow shows us that, how they generate it, how they use it. Essential for survival, short-term and long-term.
The book breaks it down into three main buckets, right? Operating activities, investing, and financing.
You got it. Operating, that's your day-to-day business stuff. Sales, expenses, changes in working capital. Investing, that's about those long-term assets, like buying property, equipment, that kind of thing. And financing, that's how they get the money in the first place, issuing stock, taking out loans, paying dividends.
Makes sense.
Wow.
But how does this help the rest of us, the non-finance folks? How does understanding cash flow make my job easier?
Such a good question. Because here's the thing, cash flow. It touches everything. Sales, marketing, operations, even HR. Let's say you're in sales, right? And you offer a customer a sweet deal, extended payment terms. Great for revenue, sure, but what about your company's cash on hand right now?
It's all connected, like a ripple effect.
Exactly. Even a basic grasp of cash flow helps you make smarter decisions in your own little corner of the business. You see the bigger picture, the impact beyond just your department.
Love that. Okay, convinced. Cash flow, everyone should be paying attention. But let's pivot a bit. The book talks about some really handy tools like financial ratios. Can you break those down for us?
Of course. Think of financial ratios like, I don't know, decoding devices. They help us unlock those deeper insights, by looking at the relationships between those numbers on the statements.
For someone who's, let's just say, not a numbers whiz, can you give an example? How do these ratios actually help?
Absolutely. Let's talk profitability ratios. Those tell us how efficiently a company is making profit. A common one is the gross profit margin. That's the percentage of revenue left over after you cover the direct costs of making your product or service.
So like, if I sell a widget for $100, but it cost me $60 to make, my gross profit margin is 40%, meaning 40 cents of every dollar is left to cover other stuff and hopefully become actual profit.
Nailed it. It's a quick way to gauge their profitability. Then there's net profit margin, which takes all expenses into account, gives you a clearer picture of the whole profitability story.
Okay, that makes sense. But what about those dot leverage ratios? They sound scary.
Uh-huh. They're not so bad. They tell us how much debt a company's using to, well, to keep the lights on. One you'll see a lot is the debt to equity ratio. Compares their total debt to what the shareholders own, the equity.
So if a company has, say, $1 million in debt, but $2 million in equity, their ratio is 0.5.
Bingo! High debt to equity. That can be risky. Means they're relying a lot on borrowed money. If the economy tanks, yikes. A low ratio usually means they're playing it safer.
Man, these ratios, they're like a whole secret language for understanding a company's financial health.
Right, and we haven't even scratched the surface. There are tons more for efficiency, liquidity, market value, you name it.
This is amazing. It's like, it's not just about the individual numbers, it's how they all fit together. Like, it's telling a story.
That's the beauty of financial intelligence. It's not just for the finance gurus, it's for everyone. If you want to navigate the business world, make smart choices. This is it.
This deep dive into financial intelligence, seriously eye-opening. I feel like I have these tools now,
Yeah.
stuff that'll help me in my career and just in life.
And remember, it's a journey. The more you learn, the better you get at navigating those financial waters, making those smart choices for yourself, for your work, for whatever comes your way.
Couldn't agree more. Thanks for joining us for this deep dive into financial intelligence. Now go out there and conquer those financial statements. We believe in you.